What's going on, guys? Welcome to the live show here from my newly built in-home studio, as we'll be doing more content. We're actually set up the studio here at my house to be able to film content more regularly. We're going to be doing a trading channel, so it'll just be me today. And the reason for that as well, we're just pretty much going to turn on Jerome Powell and listen to him speak. That seems to be what everyone wants every FOMC. So in about 12 minutes, I'll be showing Jerome Powell's press conference. We'll listen to it, we'll react to it, and of course, we'll keep our eye on the markets. If you're not familiar, I'm David, but I'm sure a lot of you are familiar with me. So with that being said, make sure to like the video and let's get started. All right, let's start with what we've all been waiting for. What did Jerome Powell and company do? Well, nothing. They did nothing. You know what's funny is we talk about this like, everyone's so hung up on the FOMC. When you take a look at the CME here, it was 99.5%. Well, that number was 99.5% that they were going to keep the rates steady, that nothing was going to change. And still people wait and they want to hear what he has to say. Well, we do have a little bit of insight before we cut over to Jerome Powell. Again, that starts in about 10 minutes. Now, one thing here from CNBC. The title reads, Fed holds rates steady, takes less confident view on inflation. So one thing I do want to highlight here from the Kobayashi letter. So the biggest tell is that the Fed is worried about inflation. The removal of the statement, quote, inflation has made progress toward the committee's 2% objective from the December Fed meeting. A long interest rate pause has officially begun. And you can see here, these are redacted. Well, not redacted, but changed. And let me make this a little bigger for you guys. So in the red is what they originally said, and then this in the blue is what they changed it to. So since earlier in the year, labor market conditions have generally eased. The unemployment rate has moved up, but remains low. Inflation has made progress towards the committee's 2% goal, but that was replaced by inflation was stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. We also have this from the Kobayashi letter again. So this is just their summary of the Fed decision. So one, Fed leaves rate unchanged, pausing the Fed pivot. What I'm curious here is we're probably going to hear from Donald Trump, right? We're probably going to hear him in a press conference later today or on social media saying, Jerome Powell is this and that. They should cut rates. They should make it easier for Americans to borrow money and cheaper and this and this and this. So we're going to see a little bit of a tug of war between the president and the Fed chair, Jerome Powell. I believe that's going to come later today, going into the week. Will that influence what the FOMC does? Now, we know Jerome Powell has come out and said, look, we're independent. We're going to do what we believe is right for the economy. We have two goals, inflation, unemployment, right? Steady prices. And so, but remember, there's an FOMC, right? The committee. And some of those people might be more loyal to Trump and more likely heed his advice or his direction than someone like Jerome Powell would. But it's important here. The decision to halt cuts was unanimous. 12-0. Excuse me. So not a single person voted to cut or hike interest rates. They all agreed that we should keep it steady. Fed says inflation remains somewhat elevated. We have the CPI numbers coming out I believe in a couple weeks. Fed says unemployment has stabilized at a low level. Statement on progress towards 2% inflation removed. The Fed seems to be aware disinflation has stalled. The battle against inflation continues in 2025. And so there's one more thing that I saw on social media. It was that the yield curve has finally uninverted or disinverted, whatever word you want to use. And typically, and this has been correct for the last since 99 or 98. Anytime that happens, shortly thereafter, we do go into a recession. That happened in 2000, in 2003, in 2008, in 2017, and then in 2020 as well. Maybe not 2017, but 2020. And so a lot of economists are saying, look, a recession is on the horizon. That's not something I'm worried about in 2025. I think potentially early 2026 or Q2 of 2026, we might see some recessionary indicators kind of come about. But with the new president in office. You know, he loves to keep an eye on the stock market, and now crypto being one of his favorite markets, as he says, right? So it'd be interesting to see what they do if we do start to see some recessionary metrics and indicators in the markets, whether that's the stock market's going down, whether that's, I mean, any other thing that macroeconomics look at. What will the Trump administration do? What will the Fed do? We know what the Fed has historically done during recessions. Print, quantitative easing, which we know ultimately benefits risk assets, which we are in a category that is considered a risk asset. Then we have this. So this is for the next meeting, which is March 18th, which is my wife's birthday. So shout out to my wife. So this one right now, so we're currently at 425 to 450 on the current rate, the effective federal funds rate. This is what the markets are believing now. 29% believe we're going to get a 25 basis point rate cut. 32% believe we're going to get a 50 point rate cut. And only 10.8% believe that this is going to hold steady. I'm just going to refresh this page, just out of curiosity to see what has changed for the March one. And you can see that's the one I was talking about, 99.5% believe today was going to be steady. So this number has gone up a little bit to 11.5% that in the March meeting. So we're skipping February, thank God. And then March, it will be the next Fed rate decision. I mean, we'll see what Jerome Powell says. And again, we'll be covering that live. But it'll be interesting to see what how the markets react. And if the markets decide and they finally are like, okay, fine, we are going to assume that the Fed's not going to do anything for the rest of the year. What will the markets do? Will we go more risk on? Will the markets continue to go risk off? We take a look at the stock market. I'm going to hop over here to a chart. So this is Bitcoin on the 5-minute. You see on the 5-minute, we've had 3 liquidation candles to the downside out of the last 25 minutes. So 3 of those candles have been liquidations to the downside. Now, again, it's a super micro as it is on the 5-minute. But I want to jump over to some macro. Let's take a look at the Dow Jones. Dow Jones is currently down 250 points. Dow Jones is down. No, 250 points for Dow Jones, down a little over 0.5%. That's bleeding off. You also have the S&P down 51 points. This is a little worse, down almost 1% on the day. Again, these are 5-minute candles. If we go to the 1 hour on the S&P 500, you can see, markets don't like to hear that Jerome Powell and the FOMC are holding rates steady. And this is the triple Q, the NASDAQ. This is also down 3.8 points, 0.73%. Even gold is down. The only thing up really is is silver. We take a look again. Let's take a look at the rest of the crypto markets here. So we have, we have Bitcoin coming in at 101,443. I did put in a short position on BTC. This was kind of in the moment, really, really quick. It was not something, it was just more of a sentiment feel versus actual, looking at indicators and what the candles are doing. ETH holding above $3,000, XRP back under $3. So really a sell-off across the board in the markets as far as crypto is concerned, and obviously the NASDAQ as well. Some of the things that are up, Dog with Hat is up, and there was a little bit of news. There was $600,000 raised by the WIF community that was supposed to go towards an advertisement on the Las Vegas Sphere. That hasn't happened, but they've teased that will happen in Q1 of this year in Las Vegas. And so I'm assuming that's probably why this thing is up. Jito is up, Uniswap is up, and Fartcoin is barely up. Some of the biggest losers, Pudgy Penguins is down 10% on the 24-hour. We have AOZ Network is down 10% on the 24-hour. XDC, this one is an interesting one. So, by the way, shout out to Brokey Yoshi. Got his almanac today. So these things have been shipped out early this week. So obviously we have one person that's received it. I'm sure there's other people that have received it as well. This is just one that we know of. We know Mo from our community also said his is going to be arriving today. So do us a favor. if you get your almanac in the mail, take a picture with it or take a picture of it, post it on X and tag us and we'll repost it for you. And so Brokyoshi, hope you're enjoying it, my friend. And thank you guys all for your patience. Really, really appreciate it. If you don't have it, now that we know that it's not pre-order anymore, you can order it and it'll be shipped literally the very next day. The link is in the description of this video to go order your magazine. And then kind of going back to this here. So XDC, so this was part of our RWA category of cryptocurrencies that we did. And XDC is not one that a lot of people talk about, but this thing has really been on a nice run. We take a look at XDC. I'm just going through the coin market cap here. You take a look at the 1 year. This thing went from around 4 pennies on the 20th of November, got to a cycle high of around 14.5 cents, 14.1 cents. I think this is a dark horse play in the RWA narrative. And so this is something that I know some of you probably know of, but a lot of people don't. Also, Jupiter is up 30% on the week, although it is down on the 24-hour. Jupiter just burned $3 billion worth of tokens. And so that caused a lot of people to say, oh, well, less tokens now, so the price is going to go up. Sitting on a fully diluted market cap of 7.3 billion. We know their app, it's either, I forget if it's already live or if it's going live, but they're going to have an app like Uniswap, where instead of just using it through the Phantom or the Backpack wallet or any Solana wallet, you can use it directly as an app on your phone with definitely more features. So a lot of people are hyped about that. And then Render is also, and really everything is down. So the question becomes, well, are any of these worthy of picking up? Let me just take a peek here. As you can see here, JP is about to step on the stage. And again, as soon as he goes live, I will close my mouth and I will play this here and I will just randomly put my face in there. We'll react. And if Bitcoin starts tanking or starts going up, I'll briefly just mention it. And then we'll kind of do a little post-mortem afterwards. And so, yeah, let me swap over here and let me take a peek at some of the comments here. So if you're new, say hello. Also, if you're new, this is not our typical setup. This is just for FOMC special, where I'm covering it live for you guys. So Maldo, Mospa, welcome. So what was the news, the FOMC meeting? So they decided to keep the rates where it is. But the important thing here, the one the markets react to is Jerome Powell's press conference, which should start literally right now. I got my eye on the video here. He hasn't stepped up to the podium yet. As soon as he does, I'll throw on the headphones and we'll listen to Jerome Powell speak. And so expect some volatility. Again, we'll be keeping our eyes on BTC and the rest of the markets as well. Let's take a look here. Yeah, hit the like button, guys. We're at 267 viewers and 69 likes. Dave, does that home setup have a club button? It does not have a club button. And maybe I'll get a club button in here before we do at the studio. But there's a lot happening at the studio. So, but that'll be coming soon. Any results? Reigns in. Yes, the result is they have done nothing. They've kept it the same as everyone was expecting. But somehow, I don't know, markets still are drawing down. It's weird. Okay, here we go. Jerome Powell. Let's go.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions.
No brand.
I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact.
Thank you.
Thanks.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we literally look at movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings and you see we don't overreact to 2 good readings or 2 bad readings, but nonetheless the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret 2 good or 2 bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much, and I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and you know, kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of you know, significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, you know, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder. And meaning, you know, plausible could be, but honestly, you wouldn't stand behind it because you just don't know. And so you're just on hold, waiting to see what comes down. You know, it's a very large economy, and policy is affected at the margin. But we're going to wait and see.
If I can follow up, the idea that you feel the economy that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
You know, we're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and you know, that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And you know, as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy, and so we feel like we don't need to be in a hurry to make any adjustments.
Howard.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes in answer to your first question, but to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available, and as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News.
Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
You know, as I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, you know, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see their alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, and not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case. But you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and, housing services, the way it's calculated for PCE. You see that coming down pretty steadily now. And that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, then we seem to be set up for further progress. But being seen to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment, participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things. And you put your finger, though, on it's a low hiring environment. So if you have a job, it's all good. But if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But yeah, I'd say we watch those things quite carefully, but nonetheless, overall, look at the aggregate data in the labor market. It does seem to, the labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half year.
I feel like he was about to say something that would tank the markets, and he stopped himself.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, now you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow over the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
You know, so what's happening is that the flow across the border have decreased very significantly, and there's every reason to expect that to continue. And so, but job creation has come down a bit too. So, you know, if those two things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make to make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
You know, we run a very careful budget process. We're fully aware that you know, we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision? Sure,
I'd be glad to. So we considered this, you know, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times, and I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, you know, and I just think it was time to acknowledge that. You know, this process dates back, thinking about it dates back a couple of years. I made the decision to bring this to the board, you know, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't, it's not right for the Fed.
Andrew.
Thanks. Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. You know, we're somewhat above that, as you know, and you know we want to see, you know, serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course. As I like to say, that you know the neutral rate by its works. So I think, at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2000 and I guess 18. We didn't really know, and the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Courtney.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that rates do appear to be abundant. As always, we stand ready to take appropriate action to support the smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point, back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and you know, it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, you know, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis. Although we'd love to see that, of course, and we will.
And a separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
You know, I want to avoid commenting even indirectly on the conduct of tariffs. You know, it's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018, there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt Egan.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see, there's nothing in the data yet on that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But you don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I don't think, I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid, downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts?
It's one of those things, we'll know it when we see it, but more the expectation is that we will make continued progress. And, that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all in changing it, if I'm being at all unclear. We're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't. We said what we said was that at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to. We looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and we think it's, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and soundness. A good number of our banks that we regulate and supervise do that. The threshold has been a little higher for banks engaging in crypto activities. And that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal, just because of excess risk aversion may be related to regulation and supervision. So.
And with respect to households and their inclusion in that asset class?
That's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have. And that's why we have, the securities laws that we have. It's why, if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.
All right. So, let me, is he still talking?
A previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews.
Okay. So, all right, couple things I have noted here. Let me take these off real quick. So, couple things I got written down here. So, obviously, a majority of that was just complete word salad. Let's take a peek at Bitcoin, and I think Bitcoin's rallying. Let's go to BTC here. Yeah, BTC's at 103.7. These are 1 hour candles. If we go out to the 5-minute candles, we've seen a few liquidations to the upside, which is good. And so a couple things of important here, okay? One, I'm just going to pull up this. Central Bank of Canada interest rate. Okay. So the one question was, let's see. Bank of America. Okay, here we go. So this happened today. The Central Bank of Canada cut interest rates because they were worried about the tariff situation with Trump. And so the question was asked, and I think it was a really good question, was with Canada decreasing the interest rate because of tariffs, is the Fed prepared to do the same? I think that was a really good question because, hey, are the countries probably going to do the same? Is Jerome Powell and the FOMC, are they going to try to front run what they think could potentially happen if Donald Trump does put tariffs? I'm trying to, God damn it, get rid of this freaking thing. If Trump does the tariffs, and are they going to try to speculate, well, is it going to be harmful? Is it going to be good? Is it going to be bad? And so I thought that was a really good question. It'd be interesting to see if the tariffs go into place. We know February 1st is a date that Trump has given. I think it was for Mexico, China, and some other country that he was going to put tariffs on. Is the central bank, is Jerome Powell and company, are they going to try to front run what they believe is going to happen? It doesn't sound like it. I mean, historically, you take a look, even when 2020 happened, what they should have done ideally is they should have looked at, okay, well, supply chains have shut down. People have gotten money. What do we expect to happen when everything opens back up? Right? I mean, I don't have the accolades that Jerome Powell does, but one's got to assume, based on common sense, that yeah, people are probably they've been at home for 3 months, 4 months. They haven't been able to spend money. Their rent payments have been put on hold. Their car payments have been put on hold. They got money in the bank. Their credit cards are they're not spending it because, well, they don't have anything to spend it on. And now they have $2,400 that just got airdropped from the government. So what do we expect to happen? And I mean, could have seen it coming. People are going to go out, they're going to travel, they're going to spend money, and supply chains weren't fully online yet. China was still in a lockdown, other countries, and that caused prices to go up. And then the Fed only reacted, right? They weren't proactive, they were reactive. And so when prices started going up, they started cutting rates. So I don't think that Jerome Powell and company are going to come in here and say, well, we can expect prices to do this when Trump puts a tariff, so let's get ahead of it. No, they're going to wait. If something happens, then they'll go and they'll cut rates. Or if the opposite, they'll go in and they'll hike interest rates. The second thing that I wanted to note, and I have it written down here on my phone, reducing rates before inflation hits 2%. I think that was a very important question. And we really, I mean, take a look at this. We really started to see Bitcoin move on that answer and question. And obviously the last one as well, essentially Jerome Powell giving the stamp of approval, not that we need it, but giving the stamp of approval that, yeah, crypto's here, our banks can, they can participate, yada, 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 blah, blah, blah. Okay, great. Everyone's probably, okay, now Bitcoin's at $104,170. I did put a little bit of a long trade in. It was, timely. Which, by the way, we got copy trading opening up here soon, and we're going to open it up to Patreon members first. So shout out to all you Patreon members, because sometimes, times like this, you just can't really put a thesis together. You're just seeing what happens, or you're like, okay, let me try to get ahead of where the market's going to react and where I think price is going to go. And that's really what happened with the long and with the short. Made money on both of them. Either way, that second question was very important because everyone's sitting here saying it's all speculation. What do we think the Fed is going to do? You want to try to front run it, right? The whole idea is to put in a trade or put in a position before the Fed does it. So with his answer of no, we don't need to see inflation go down to 2%. Put yourselves in the mind of an investor, of a hedge fund, of people that move millions and billions of dollars, the market movers. They're sitting there saying, okay, he's not going to, so we can get a rate cut before we go down to 2%. We can, we don't have to wait. And so I think that's why you're seeing the markets rally. Let's take a look at the traditional markets here. Just a quick overview, and I bet you, Nikkei is green. So the U.S. markets are still red. Here, I'll just go to trading view here. We'll go down to our macro. Dow is down only 14 points. S&P's down only 14 points, 0.25%. Dow is pretty much flat. And this is, again, Dow on the 5-minute. You can see here, this was about 5-10 minutes ago where he talked about, with the whole inflation thing. And then the triple Q is actually in the green, all right, the NASDAQ. So that's pretty good. And then again, BTC, 104.5, okay, 104.5. So let's zoom out to the daily. Look at this daily candle, right? This is so far a 3% daily candle. We have RSI currently sitting at 58. And so this is a very, very strong candle. I mean, look at the body on this one, no pun intended. And so we'll see if this thing continues. For me, I'm kind of stuck in, I don't know why. Don't ask me why. That's not how I feel. The sentiment across the board is somehow bearish, and Bitcoin's at 104.5. You know, a lot of people had exposure to AI, myself included, and that sector has taken an absolute beating, right? We saw what happened with NVIDIA, and that kind of trickled in to the AI agents in the AI sector. And I do think AI is going to bounce back. It's important to position yourself in projects that you believe or we believe are going to bounce back the fastest and the strongest. But the sentiment, I don't know, it's just in the gutter right now. So I'm just worried this might be at least on the short term, a bull trap. I know a lot of people are talking about it being a bear trap on the longer term, and you can surely make the case for that. But if we throw on, let's take a look at where the trend is currently. So the trend is still green, right? The trend is still green. We're still in an uptrend, right? And so we did get a wick to this 97.7 level, which is the top end of our cloud, which perfectly held. I mean, perfect. You want to talk about perfect support hit? This is it right here, my friends. This is it right here. Barely pierced the cloud, and then prices reacted positively moving forward. And so it'll be interesting to see how this thing pans out. You know, you go back down to the 5 minutes, some of the lower end. Of course, obviously the trend is still green there as well. RSI on the 5 minute at least is approaching a little bit of overbought territory. If we go out to the 1 hour, this is a nice clean break. So this morning at 6 a.m. Pacific time, we were kind of in no man's land, and we've since rallied from around 101.5 to 104.5. So nice little gain there. And the RSI is actually overbought on the 1 hour. So that's one thing to keep an eye on. But either way, you're going to see a lot of front running. And so those two questions, I think, were the most significant to me. And there was one point, I don't know if you guys caught this. There was one point where he was about to say something, and he stopped himself. And I think if he would have said what I think he was going to say, I think the markets would have tanked. It would have been pretty funny. So, yeah, guys, same old. We're going to wait for more data, yada, yada. Two big takeaways. Tariffs. What is the Fed going to do? Also, Fed could potentially cut rates before hitting their 2% interest, which I think is very important. So that leaves more for speculation. With that being said, let's take a look at the CME watch tool, what investors after the press conference believe Jerome Powell will do in the March meeting. And we're now down from 11.5% on keeping rates steady to 9.6% and 32%. So let's just put this all together, right? 25 to 50 basis points. We're almost at 50. We're over 50% of investors believe we're going to get at least a 25 basis point rate hike. And so obviously we have some time between now and March 18th. About 6-7 weeks to be exact. And so these numbers will update, and we'll kind of keep them updated for you guys. And then just to take a look at the rest of the markets, how the altcoins are reacting. We'll take a look. You know what? Let's go down here. Let's check out the total 2, which is everything minus BTC. This is also up on the hour, on the 5 minute. Could potentially be seeing a little bit of a pullback here. And then on the daily, let's take a look at the daily here. So good news is we are back in our cloud. So this is really good. Now we do want to get a break back above our cloud. And the other bullish thing here I'm seeing on this Ichimoku indicator is our baseline is about to cross the conversion line it was about to cross the baseline, but that looks like it's going to diverge yet again. And so this is looking good. Going back, some of the top gainers in the last 1 hour. Fartcoin, let's go. I think we have a Fartcoin trade still open. Let's take a look. Do we have a Fartcoin trade still open? We do. We were in the red. Oh, shit. Damn. We're up 35% on this trade. So our TP was $1.42. We re-entered. And so up 37%. I think this thing's still going to run. Let's take a look at a Fartcoin chart here. How funny, right? Fart coin. Can you imagine the chair of the Federal Reserve being asked a question about fart coin? Fart coin has been the leading indicator for artificial intelligence. Oh, this is looking real good. Okay, so we got nice volume. We got a break into our cloud, or a break above our cloud. And you can see here, the reason I love, this is an indicator I lived and died by when I was trading stock options. And it did so well for me, and I love using it. It's so simple to just throw this indicator on, take a look at where is the trend, and what are some key levels of support and resistance, because this thing is absolutely, I don't want to say immaculate, but it's pretty damn good. You couple that with a few things like ATR, RSI, and a MACD. Keep your eye on the volume. This is looking bullish. We'll see how the daily candle closes. If it closes above, if we go out to the 4 hour, we are still below our cloud. The top end potentially, which is my take profit again, is going to be $1.45, which on the 4 hour is actually where we should meet a little bit of resistance for fart coin. And then if I throw on the price action concepts, take a look at where's money coming in, where's money going out. So this order block here, around 27% of all trading happened here, and we do have a little edge from the buyers versus sellers. We also had a change of character in the chart, meaning we made enough higher highs to change the character of a downtrend again on the 4 hour from our previous week high of $2.47. The next key level that I want to see fart coin break is going to be this order block here, which around 5.4 million fart coin or dollars were traded, and a majority of that was buying there as well. And so this should be an important level. That level is around $1.37. If we can clear that, there's really nothing, and I'll throw on our volume range profile here. Yeah, you see that level here. You see this big volume node. That's around that $1.35 to $1.45 level. If we can clear that high, if we can take out that high, I think the reversal, at least on the 4 hour, is there. And again, on the daily, just a beautiful green candle. Beautiful, beautiful green candle. And so, yeah, and you see tons of volume here at this level. So really, we look back, and I mean, this was such an easy, you take a look, just historically, this was such an easy long here. One, you have this large order block that a lot of buying happened. Last time price came down here, look at this large candle, right? But you have a little bit of a wick to the downside, but it was a large bodied candle that continued to go up all the way from the wick low of around 66 cents to a high of over $2.70. We had a liquidity grab in this area. This was back on January 11th, and going all the way back really to December 23rd. This was another bottom here for fart coin, where we saw a rally, an initial rally of 90%, so it doubled, and then extended rally of around 150%. The more recent one, which again was back on January 13th, we saw a rally of 260%. Now, am I saying we're going to get that? No. The other thing to watch out here for on the daily is a potential head and shoulders pattern here. On the daily chart, we'll see how this plays out. Potentially, again, that $1.45 level for me is going to be the most important level to look out for. And so, markets are looking good. I guess people are bullish. Also, SPX 9000 is up 13% on the hour. This is the hour, guys, not the 24-hour. 24-hour fart coin is up 35%. Virtuals Protocol, nice bounce back. I'm curious, did you guys pick up Virtuals Protocol when it dipped? Let's take a look here at Virtuals Protocol. Did you guys pick up the dip here? Now, the one thing I do have here is I had this head and shoulders plotted out. And so I'd be careful if you're in a trade, or if you're looking to maybe cash out some profits. This $3 level is our neckline of our head and shoulders pattern. And so this should act as resistance. But if you picked up virtuals at $1.80, put a 1 in the comment section. That would have been a great pickup. Still super bullish on this project. Get a lot of questions about, are you still bullish on virtuals? Are you still bullish on this? If anything changes, I will do a write-up or do a video. I'll let people know. And I'll definitely, the Patreon members are, I would say, the most tuned in, or the most up-to-date on my thesis and my analysis. Obviously, if it's something urgent, I'm not going to hold back information that's going to make the community lose money, because I love you guys. But as far as any minute changes or any altercations or alterations to my portfolio, I'll definitely Patreon members. You guys will get that info first. We want to reward the people that are supporting us, and so we appreciate you guys. But this virtual again, looking to maybe get some resistance right at that $3 level. But if you picked it up at $1.80, great buy. This thing has been beaten down. The whole AI narrative. We had our RSI go all the way down to almost oversold, about 33. So, yeah, I mean, that's kind of all I got. Let me throw this on. Let me take a peek at the, let's take a peek here. Let's see. So we got 260 viewers, 147 likes. Not bad. Could be a lot better. I'm going to close this poll here. How will markets react to Jerome Powell? 58% of you said up. And I'm sure some of you maybe put in your, cast your vote prior to, or after Jerome Powell started speaking. And so, yeah, just kind of looking through this. I bought VVV instead at the lows. That's an interesting one. You know, I got like 1,300 coins airdropped across 3 different wallets. And, you know, obviously with airdrops, historically for me, looking at the data, we do see big sell-offs almost immediately because people get free money. They want to cash it out. There's nothing wrong with that. So I sold around 60 to 70% of it, around between $12 to $16. And so the others, I staked it though, because you got Eric Voorhees behind it. You know, he's got a good name in crypto. He's not a scammer. The guy's been around for a very long time. And also the utility there is very interesting. And so that's something, and VVV is an interesting one. Could that be a $10 billion coin? Potentially. Benny said, patiently waiting my almanac. So Brokioshi did get his. If you ordered one, check your email, because you should have gotten a confirmation or a tracking number for your almanac. Also, if you're overseas, the shipping does take a little longer. And so if you're in the US, though, you should get it in the next couple days. And so do us a favor. When you get your almanac, take a picture with it or take a picture of it, post it on X and tag us. We would love to amplify that and just to show, you know, hey, we appreciate you supporting us. So thank you very much. Guys, that'll do it for the show today. I just wanted to thank all of you for tuning in. I know some people are bored with the FOMC, but at the end of the day, we might not care or might not say, well, he's keeping the rate steady. But the markets, the market movers, this is what they do. They take the information in real time and they used to trade with it. And so we can make money with that as well. Why not? And that's what we're going to continue to do. So we're back to our normal streaming schedule tomorrow, which is 11 a.m. Pacific, 2 p.m. Eastern Standard Time, live in studio with the rest of the crew, including Ashley. And so also I want to give a shout out to Mike Owen. He just became our latest Patreon member. So shout out to you, Mike. Make sure you link your Discord to your Patreon so you get access to that as well. And with that being said, guys, thank you so much for tuning in. Love you guys, and we'll see you tomorrow. Peace.